Hey guys, hope you all had an amazing Christmas this year. As I said yesterday, I'm going to publish the entire interview where Bernie Madoff pretty much exposes how hedge funds use things like liquidity and cost to customers as ways to get regulatory firms to let them function with little to no oversight. The whole interview is honestly quite amazing, given that Bernie talks a lot about the same practices used by modern-day hedge funds to attack prices and manipulate markets to be what they want, even using dark pools. A funny thing that is not on this interview but you can look up yourself is that while Bernie was in prison, he was asked about his family and if he missed them. Bernie of course said that he did miss them, but upon being pressed to expand a little bit on that, on how he felt, Bernie's answer was quite interesting. He began talking about how he missed the way people talked to him and about him, how they revered him and how he no longer had the admiration he once enjoyed from his family. Funny enough, this interview took place after the death of his own sons too, adding to the unscrupulous nature of the psychopaths that run the market casinos on Wall Street. It is without a doubt that this man strongly exhibits antisocial personality disorder characteristics, as well as histrionic and narcissistic. This video will be a pretty long one, so I hope you guys thoroughly enjoy it. It's honestly one of my favorites given the wealth of information being disclosed without any self-awareness. Before I leave you to it, please do remember to come join my Discord. We got tons of content there for you guys, ranging from day trading alerts to educational content, all at your disposal with the simple click of the invite link. With that said, here's the interview.
I'm Francis Levy, co-director of the Philip Teddy Center. Ed Nersessian is the other co-director. Good afternoon and welcome to the future of the stock market. I'm now proud to introduce Justin Fox. Justin Fox is the business and economics columnist for Time magazine and writes the Curious Capitalist blog at time.com. Before joining Time in January, Fox spent more than a decade at sister publication Fortune, where he covered a wide variety of topics related to economics, finance, and international business. Fox's book, The Myth of the Rational Market, will be published by HarperCollins in April 2008. Justin Fox will moderate this afternoon's panel and introduce the other panelists. Thank you, Justin.
Thanks, Frank. And I just had a conversation with my book editor the other day, and now he's saying August at the earliest. So I don't know if that book's ever coming out. But anyway, so we're going to talk about the future of the stock market, which I think of necessity will require us to talk about the past and the present. And we have a really cool panel here of people who, most of them are extremely specialized in certain areas of the market. And so this is going to be this sort of getting specialist. I'm a generalist. I assume most of you guys are generalists, not market microstructure experts. And so it's going to be a challenge, but I think it's going to be this really wonderful opportunity to make a little more sense of these things we read in the financial pages than we normally do. And so what I want to, well, why don't I just introduce everybody and then I'll start asking questions and you'll see where we're going to start. Our panel, to my left is Elsa Roel, who's a professor of international and public affairs at Columbia University's School of International Public Affairs, and her specialty is financial economics. And in the past, she'd done a lot of work on regulation of financial markets. Lately, she's working more on corporate governance matters. To her left is Bob Schwartz, the Marvin M. Spicer Professor of Finance and University Distinguished Professor in the Zicklin School of Business at Baruch College, CUNY. I got to say, university titles are even more complicated than magazine ones. Yeah. His research is also in the area of financial economics with a primary focus on the structure of securities markets. To his left is Muriel Mickey Siebert, who runs Muriel Siebert and Company, a brokerage. She was the first woman to own a seat on the New York Stock Exchange. And what year was that you bought that?
December 28th, 1967.
And we're going to get back to that in a minute because I think the market was a little different then than it is today.
A little bit.
She also served during a really interesting time as superintendent of banking for the state of New York, basically right when the banking industry was first kind of coming to terms with this whole new world of financial markets, and a lot of banks were struggling with it. To her left is Bernie Madoff, who's the chairman of Bernard L. Madoff Investment Securities, LLC, which he founded in 1960. That name may not say a lot to you, but you go over to Madoff and you talk to Bernie and he mentions, oh, by the way, 10% of stocks traded in the United States are going through this firm right now. It's one of those really important parts of our financial system that doesn't show up in the headlines, that most people don't, outside of markets, don't understand the role it plays. But it's a major factor in American and global financial markets today. And next to him is Josh Stampfli, who's the head of automated market making group at Bernard Madoff Investment Securities. He designed the, I'm going to just read the sentence right here because it's so beautiful. He designed the trading logic to manage position risk and handle the order flow inherent to the firm's business of providing liquidity to its customers. He's going to explain what that means in a little bit. But I want to start with Mickey Siebert. Just when did you first arrive on Wall Street?
Well, I moved from Cleveland to New York, and I'm a college dropout with 18 honorary doctorates. December 1954 from Cleveland, Ohio.
And what, I mean, when people talked about Wall Street then, was it really all down around Wall Street?
It was down around Wall Street. I had been to New York once before on vacation, which included a tour of the balcony. And I said, this looks exciting. Maybe if I ever move to New York, I'd like to work down here.
And when you did you work on the exchange immediately? Or
No. Actually, I applied to the UN for a job first because my mother was the youngest of 11 children. They were all born in Hungary. They came here in 3 tranches. And my Uncle Ben's oldest son was one of our representatives to the UN. So I applied there for a job. Thank God I was not accepted. I would have been a messenger girl with fallen arches. And then I applied to Merrill Lynch. And they said college degree, and I had to say no. And they said no job. So the next day I applied to Bache. They said college degree. I said yes. And I kept that lie going till I put the bid card in for the seat, which I bought because I wanted to be paid equally.
And as I understand it, the people at the stock exchange didn't exactly bend over backwards to help you with that.
They did not welcome me with open arms.
Right.
But I had been a partner of a small firm, a couple of small firms, and I was doing research, and I had a following from institutions. I had become the first woman member of the Wings Club. I used to specialize in aviation stocks. And when you're from a small firm, you can prove it's your business.
Right.
If you're from a Merrill Lynch, is it their business or your business?
And so why did you feel you needed to have an actual seat on the stock exchange?
I wanted to be paid equally, and I asked a client of mine, you'll know him, Bernie, Jerry Tsai, gave me the idea, the Chinese money manager. And I said, Jerry, what firm can I go to where I'll be paid equally? He said, don't be ridiculous, you won't. Buy a seat, work for yourself. I said, don't you be ridiculous. And he said, I don't think there's a law against it.
And at that time, all of the trading, I mean, was anything automated yet by late 60s?
Nothing was. They had started about that time the DOT system, direct order turnaround, which was started originally for small orders, which enabled, it really took hold when discount brokerage started, which was May 1st, 1975.
And before that, you had to charge a certain commission?
You had to. The commissions were fixed.
And you were one of the pioneers in saying, okay, we'll charge that.
I started as what I called an execution-only broker, day one. I was on the front page of the Wall Street Journal.
What does that mean, execution only?
I stopped doing research.
Okay,
At that time, I had 3 or 4 analysts that did research. And we stopped because there were 2 laws coming together at one time. If one had come in and then the other one, but it was the 2 laws. One that said commissions could be negotiable, And the other one was ERISA, which at the time we called everything ridiculous invented since Adam.
In Congress, they call it the Employment Retirement.
Yes, it said that if you were a
something.
fiduciary, you had to get the best execution at the lowest cost.
Got it.
Now, without the negotiated rates, we were all charging the same. It would have been a non-event. But it was those two laws coming together, and the head of Manufacturers Hanover Trust Department had said to me, you know, we've been having meetings. How are we going to continue to pay for research? And that's when I decided that whenever you see a change of that magnitude, there's got to be an opportunity.
Somebody else who saw an opportunity in all the
boy.
changes going on.
I take my hat off to him.
Well, describe your history. You started your firm in 1960? Or?
1960, correct.
And what did it do initially? Because that's before all this change happened. So.
At that time, we started what was an over-the-counter dealing firm, primarily just making markets and trading in over-the-counter stocks.
I got to stop you because I think this is a phrase that's going to come up a lot. What is making a market?
Well, making a market is the over-the-counter dealer equivalent of a specialist on the floor of an exchange. It means providing a two-sided quoted market to other dealers, so that if you wanted to buy, let's say, Intel, and you went to your broker and you said, buy me 500 shares of Intel, he would take that order and execute it by going to any number of other brokerage firms who were called wholesalers, like myself, that provided a ready market for that stock by risking our own capital. So we would provide liquidity to Merrill Lynch by offering him the stock at a quoted price, or buying stock from at a quoted price. If you executed an order in IBM at that same time, you would take that order in those days to the floor of the New York Stock Exchange, and that order would be executed with a specialist who is also a market maker, but primarily trading on the floor of the exchange in a franchise that he was given by the exchange in a number of stocks.
So you'd be doing it for stocks that weren't on the New York Exchange?
In those days,
Right.
Correct.
And then what? So obviously things developed over the next 2 decades. What?
Well, I guess from our standpoint, we started the firm in 1960. In 1970, and in those days, over-the-counter stocks were traded always over the telephone with no automation. So you would call a broker. The broker would call up over the telephone any number of dealers like myself, and there were hundreds of dealers around the country that were making these markets. And it was an arduous process of saying, okay, where could I buy 100 shares of Intel or 100 shares of Apple, which of course didn't exist at that day, nor did Intel. We would negotiate over the telephone. If you wanted to see what the price of the stock was, there was a publication that came out daily that was just circulated throughout the brokerage industry called the ping sheets. It was just a stack of sheets this long, this wide, that
For those behind him, he's
right,
like
that would basically list all of the dealers like myself that were willing to make a market in that security, and the prices that we were willing to trade the security at. And of course, that was a day old, so it really didn't mean much. All it did was it was a phone directory of telephone numbers, and that was the way the business was done for many years. We, in about 1971, automation people were interested in technology. I mean, computers were basically just sort of showing up, being used at that time. So we saw, meaning my brother and myself, that there was an opportunity to bring automation into the over-the-counter marketplace and create some visibility, transparency in the marketplace. So we came up with the concept of developing a screen-based trading mechanism where prices would appear on a computer screen, and that was the start of NASDAQ. So there were 5 firms: ourselves, Allen and Company, Merrill Lynch, the old Prudential, Bache, and Goldman Sachs. This got together, and went to the NASD, which was called the National Association of Securities Dealers, made a proposal to build a screen-based trading system, which then became NASDAQ. And then that went through various stages of automation so that you were able to, turn on your computer screen at any brokerage firm in the country. It listed all the dealers that were willing to trade the security and the prices. And then eventually that went on to where you could actually execute the trades automatically. And at that time, that was literally the only automated trading environment that existed in the world. Everything else was floor-based systems where there was a central marketplace.
And in terms of the NASDAQ, obviously, by the 90s, everybody knew about it. Was that partly, I would imagine it was smaller, more obscure companies, but a lot just sort of stuck with it as it grew?
Yes, originally, the over-the-counter market primarily was a marketplace that had smaller companies that did not qualify for listing on the New York Stock Exchange. But at that time, 90% of all corporate bonds that traded in the United States were traded over the counter, and all currencies trade over the counter. I mean, the over-the-counter market is far larger than any exchange market, basically than all the exchange markets, put together. But most people looked at the over-the-counter market as being a marketplace for sort of unseasoned companies at that time. And NASDAQ was lucky enough to basically be the home of all the technology companies in the United States. So companies like Apple, Intel, Microsoft, MCI. I know I sound like a salesman for NASDAQ, but that's that's what gave me whatever success we achieved. So those securities all had a home in NASDAQ, and those securities, for the most part, never left NASDAQ, even when they qualified for listing on the New York.
Now, Bob, how long have you been studying the structure of markets, how they've been put together?
I knew you were going to ask me that. And I'm sitting here thinking, God, I never incorporated. I never went for a job interview to study markets. When did I get started? In the 70s, 1970s.
Was that
early 70s?
Had there been a lot of academic interest in it before, or was that a relatively new field?
It was new, and it was lonely. And all my buddies would say, we're modeling price setting, we're modeling what a stock should be trading at given its risk and the capital asset pricing models and that sort of stuff. And you're looking at bid-ask spreads, an eighth of a point, 12.5 cents. It was not only lonely, it was a little bit negative to what we were doing. And then, of course, you don't study something if it's just a totally efficient market. What's there to study? And you can't publish a paper saying, well, some people did, actually. There were a lot of tests of what was called the efficient markets hypothesis, that stock price movements the changes are uncorrelated, that they follow what we call random walks. That's a pretty common term, I think, especially on 3rd Avenue after happy hour. But, then we started looking at this data, and in those days it was very hard to study the markets because a big benefit of electronic trading is it gives you the data. We have, all the intraday, they call it high-frequency data. Our high-frequency data were collected by hand by doctoral students, slaves. That would arduously build up a database, but we started looking at daily data in a special way, me and a couple of co-authors, and we saw evidence of inefficiency and tried to get those papers published. It wasn't easy. So I sort of slid into it, but I was at NYU at the time. I was there for many years, and NYU at that time was right next to the American Stock Exchange. So it was very easy, and as I say, just across the graveyard from the NYSE. So it was easy to go and visit those markets and see what was happening. And Bernie, I grew up near the exchanges, and I was always more sensitive to the exchange type of markets than the OTC market. But of course, the issues span both of them. So I sort of, my research topics got me into it. The topic didn't have a name then. There was a paper by Mark Garman that Elsa knows that came out called How He Came to, I've met Mark, but I never asked him how did he get that name. It's just the title of a paper. And a bunch of
This
us...
was market microstructure?
Market microstructure. It was a very good paper, the pioneer. But a bunch of us, it turns out, start working on related topics, and we got in touch with each other, and we came together and said, help, you need friends in this lonely field. And we decided one day, about 4 of us at a room at NYU, if we're going to coalesce interest in this topic, we have to give it a name. And Mark Garman's paper title sounded like a great one, and it miraculously stuck. And when I talked to you yesterday, Justin, I said, you know the term microstructure? You said yes, you made my day.
But I said I knew the term. I don't really know what it means.
You're like my students.
Exactly. Well, and I guess, my initial thought is, so does this, when you're studying market microstructure, does it mean there's a big difference between the way people arrive at prices on the floor of the exchange or on the NASDAQ, or, depending how you set up the system?
Yeah, that's a very good example. My background's economics. I'm not a finance through the PhD. It's a very different area. But my first years at NYU, I taught microeconomics. Microeconomics, if you think of it, has a lot to do with markets. But how intensely do you put the microscope on the markets and look at the real details of what's going on? With microstructure, we are looking at those details, the orders that come in, how are they handled, what mechanism are they brought to? Is it to Bernie or Muriel or the exchange? How does that work? How are they translated into prices, trade prices? And how do the prices behave? And it all feeds back, for me, to market structure. I care a lot about how you structure a market to perform better.
Well, have we structured, in this great transformation of our markets over the past 40 years, is it set up to perform better?
Well, the intention is always to perform better, and yeah, in lots of ways it is better. And when you're talking about screen-based trading and that sort of thing, the transparency is, when I look at the markets today, and I go back, I was around in the 70s, I still hate to think, what were they really like then? And that is the era when academic, I'm glad that Elsa's here because you can support me, it's us against a lot of colleagues. We're all touting the efficient markets hypothesis. And I think a big reason why is that my PhD is from Columbia. And when you get a PhD in economics, you got to fall in love with the free market. We're very free market people, lots of us. And if you're in favor of the free markets, because the free market gives you good results. Well, but when you start studying actual markets, nothing's that perfect. It just plain isn't. And the imperfections in the exchange market add up to a lot of dollars. Some win, some lose. But is it really good for us collectively? I think the answer is no. Now, are the markets really that efficient today? Let's put it this way. I think I have a lot more work that should be done. I'm not ready to get on to a different topic or retire.
Well, and I assume you aren't either, Elsa. I guess that, you can take this sort of wherever you want, but my thought is, are we moving towards markets that get closer to the right price than we used to because of all this change toward more electronic trading or not?
I do think that the electronics has made it possible to bring together quotes and orders from a very large group of people, a much larger group than before, instantaneously. And so in that sense, we have a better chance to find the right price. Now, in terms of talking about, is the market more efficient than it used to be? There's some, there are different definitions of efficiency. I do think the market has become informationally more efficient, that it brings information together better. It has become operationally more efficient in the sense that the costs of performing the transactions have fallen dramatically, both through the electronics and through the deregulation of commissions that Muriel was talking about. What I do think, though, is that still, at this time, there are always conflicts of interest between different groups of actors in the market, the intermediaries, the small customers, the big pension funds. Different constituencies have different ways to profit, and to some extent there is some back and forth in the sense that one constituency may gain from a change that others may lose from. So we're trying to be on the Pareto frontier, as it were, but I think there's still some issues as to the divisions of gains and losses.
What's the Pareto frontier?
With Pareto frontier, I just mean that you can't really make that many people better off without making someone else worse off.
Right.
Okay, so we're there, but the division of the gains.
Justin, I want to say something. Bob was not a very popular person on Wall Street when he first started looking at these subjects. You have to understand that Wall Street is one big turf war. So, as Elsa just said, by benefiting one person, you're disadvantaging another person. And the basic concept of Wall Street, which sometimes the regulators lose sight of, as do the academics, is it's a for-profit enterprise. You know, in every aspect of it, the person that is buying a share of stock is convinced he knows something that the other person who's selling it to him does not know. There's no zero-sum game in Wall Street. So when Bob first started to look at market structure, whether it be macro market structure or micro macro structure, and he started asking questions of the established ways that business was done in Wall Street, no one wanted to deal with that because everybody was very happy with the way things were. You know, commission rates were you know, 80% higher than they presently are today. Everybody was making a very good living. Regulatory.
So commissions have, even since deregulation, obviously at deregulation they dropped a ton, but they've kept dropping since then?
Well, they've gone down to virtually nothing. So what you have now, outside of Mickey and a number of firms, other discount firms like hers, nobody really wants to do retail business any longer because nobody wants to do business for 5 cents a share when it used to be 75 cents a share. And Wall Street, so just so you understand the scope of it, it's one of the few industries where the cost of doing business for the consumer has gone down dramatically from a commission standpoint. Yet the expenses of doing business from the industry's perspective has dramatically increased. And the cost of regulation has dramatically increased. Now, no one's going to run a benefit for Wall Street. So whenever I go down to Washington and meet with the SEC and complain to them that the industry is either overregulated or the burdens are too great, they all start to roll their eyes, just like all of our children do whenever we talk about the good old days. But that being said, even though Wall Street has resisted these changes, they made the changes, you know, not easily, but the academic community that started to look at, you know, the structures of the marketplaces, and people like Mickey, who started really the whole movement towards negotiated rates and the discount type of an operation were the driving forces that caused that. And people blame me for a lot of this because we were the ones that started the automated trading and that were servicing clients like Mickey in the old days and Charles Schwab and so on. In those days, I mean, everybody hated the discount firms. No one wanted to do business with the discount firms because they were the first ones that were driving prices lower. But they were dragged kicking and screaming into the 20th century, so to speak. But they did make the changes, but it created a lot of issues along the way.
Well, and you sort of raised this question, which is, okay, commissions are almost nothing, and yet you are a for-profit enterprise, and maybe we can bring Josh into it too. How do you guys make money then?
Well, today, basically, the big money on Wall Street is made by taking risk. That's where and that was sort of, firms were driven into that business, including us, because if you couldn't make money charging commissions, primarily because the rates were lower, as I said, and the infrastructure costs, particularly the technology and the regulatory infrastructure you had to have dealing with clients. Everyone said, listen, I might as well risk my own capital and trade. So if you looked at the earnings reports of the firms like Goldman Sachs or almost everybody today, any of the big and large investment banks, the great majority of their income comes from risk taking. In other words, proprietary trading, putting the firm's own capital, providing liquidity to institutions or to individual investors, primarily institutions. That's where the money is made.
And is this something like when you're doing all this trading for other people, is that something that is, I've just never fully understood, is that a completely separate operation? Is there information going back between people who are doing the trades and the ones who are taking the bets? Or? Well,
yeah, there are so-called Chinese walls that are required to be established at every brokerage firm, so that there are what they call information barriers, is a better term that most people would understand, to sort of wall off a brokerage firm from taking advantage of information that he has as to what clients are basically going to trade or not going to trade. So there are separate divisions within the firms, and it is very carefully enforced and surveilled, so that there are these various. Doesn't mean there are not abuses, for sure, but by and large, in today's regulatory environment, it's virtually impossible to violate rules. When this is something that the public really doesn't understand, and if you read things in the newspaper and you see somebody, violate a rule, you say, well, they're always doing this. But it's impossible for a violation to go undetected. Certainly not for a considerable period of time. And when you consider the volumes of trading, the trillions of dollars of trading that go on, our firm, for example, alone, we trade in excess of $1 trillion a year. So, and that's one firm. So when you look at the scope of the trading that goes on today in Wall Street, and you look at what we would consider to be the infractions, they're relatively small. Primarily because, of all the regulation. And most firms do try to comply with that.
I want to get back to regulation a bit, but I want to put Josh on the spot finally. So basically, well, just describe what the heck you do.
Okay, so the way I view market making is, let's say you're Joe Retail and you want to buy 100 shares of Citibank or something. So you give your order to your broker. And then your broker can either send that order to the New York Stock Exchange, at which point you trade against somebody. Somebody sells those shares to you. Or they can send it to another destination that will sell the shares, because the broker isn't the one selling the shares. For you to buy the 100 shares, somebody actually has to take the other side and to sell those 100 shares. So we're a destination that brokerage firms route their order flow to, and then we satisfy the execution side of their customer order. And as a result, we're constantly being put into a portfolio of positions, long some stocks, short other stocks, as a result of the customer order flow. And so you have to manage that risk and work your way out of it. And that's sort of how I see the business of market making.
And how did you end up, what is your background? What does one have to do to end up building these models?
I took the wrong route, which was I started off actually.
How did you tell us this?
I said I was going to tell you in the interview.
You went to the first firm and they asked if you had a PhD and you said
exactly.
no. You said yeah.
And I didn't make that mistake. But I traded bonds for a little while, and then I went to a hedge fund and fixed income and another hedge fund, and I sort of left, went back to school briefly, participated in the startup internet mania, and when I finally sort of figured out that wasn't going to work either, I'd been working at a firm where our product was an automated system to internalize a brokerage company's order flow. So the idea was maybe instead of taking their order flow and routing it out to another destination for execution, maybe the brokerage company itself should be providing some of these executions to its customer. And it was a natural fit for Madoff, because that's their business, is the providing executions on order flow. And so we, like many startups, ran out of money in the crash. We were burning as fast as we could fund, and then the funding disappeared. And so I went out and talked to some of the people that we talked to while I was with the company, and Madoff, Mark and Andy, Bernie's sons, brought me in and gave me the opportunity to build automation into their existing business. And
I mean, the way because I visited Madoff, and it's a very quiet place. Considering all, you just think of the history of Wall Street, and even now still in the Chicago exchanges, all these people yelling, and I guess I'm just struggling with this idea. What is the idea that humans are setting these policies? Like, okay, here's what we're trying to do, but then you let the computers and the algorithms take over from there because they can do it much more efficiently on a case-by-case basis, and this is sort of for both of you.
Well, let me try and explain to you how orders are handled. I think if we take a few minutes there, I think people will understand it, and you can look at the transition that occurred, over the number of years. If you, and I covered a little bit of this in the past, but I think it's worth going back. You call the average person, you call your broker, whether it be Muriel Siebert and Company or whether it be Merrill Lynch, and you say, buy me 500 shares of stock. And depending upon whether the stock is a NASDAQ stock or whether it's a listed stock, meaning a New York Stock Exchange stock, you will take it to either the floor of the exchange, or you could take it to a dealer. Now, also, what's changed during this time is New York Stock Exchange stocks trade everywhere. They trade actually as much off the exchange as they do on the exchange, but that's sort of unimportant. So you put an order in, you call your broker, say, buy me 500 shares of stock, and they'll send that stock to the floor of an exchange, either here, Europe, wherever, or they'll send it to a dealer, what we call an upstairs trade. And that trade then, normally in the past, it got handled in a totally manual mode. If it went down to the floor of the exchange, everything you see, all these crowds on the floor, people would physically walk an order over to a specialist post, and they would say, I'm looking to buy 500 shares of stock, and the specialist who was assigned to that stock would execute the trade with them. Either he had an order from another person to put the orders together, or if he didn't have an order, he would risk his own capital to provide liquidity on the other side of the transaction. If you did an over-the-counter trade, it was originally, going back, pre-1970, it was done the same way. And then automation through computers started to come in to be able to use computer technology to make those orders, be handled more efficiently. And the average order that used to go on as late as probably 80-something, mid-80s, with taking probably on the floor of an exchange 20 to, either somewhere between as fast as 20 seconds and as slow as 2 minutes, correct? I mean, I'm being generous to my competitors, the exchange. That's how long an order took place. And it wasn't that much faster in the dealer market until you made all these phone calls. But with automation, today, our average turnaround time for orders is 1/10 of a second. So we, for example, built linkages to all the discount firms in the early 80s, where we provided technology so that a customer, and Charles Schwab, if you go back in those days, you remember they were on, I'm sorry, Mick, you have to use Charles Schwab as an example, because they were the first client that we did this for. You could call, they had an ad where somebody was driving in a car and called up on a cell phone and said, buy me 500 shares of IBM. And, then while he was within literally, let's say 6 seconds, you would hear the ad would be, okay, the broker calling back on the cell phone, you just bought your stock. And literally this happened in 6 seconds. Now, on the floor of the exchange today, with the automation that they've done, the time frame has also dropped. Maybe not to 1/10 of a second, but certainly probably in the 5-second range, you would say, Bob, turnaround time. So that's a tremendous, that is the way orders got handled in delivering an order from a customer into the marketplace. So that's literally one half of the order, because the customer wants to buy and sell. He has to get that order into the marketplace, whether it be an exchange or a dealer. What no one really knows, or pretty much doesn't care about from the public standpoint, is what happens to that order after that. What do they do? You know, no one really thinks about it, because as long as they got their execution, they don't care what happened on the other side. And of course, they want to make sure they bought it at the best price, which you're required to do by regulation today. What happens once the order gets delivered to either a specialist on the floor or to a market maker like myself is we have to determine what do we do with that order. If we have a ready buyer, that's the ideal situation. Then we match it, and we've made either the spread or we make commissions on both sides, depending upon the structure of the firms. But if we don't have, then we risk our own capital. All right, now, where Josh comes in is, if you look at our firm as recently as, I would say, 10 years ago, all of our orders were handled, they were delivered automatically into our firm. But what we did after that was a manual process, meaning the trader sat there, what we call a market maker or a trader, and we had, let's say, 100 traders sitting in one room, and they would make a decision: do I buy that stock? You know, what, do I keep it, or do I sell it out, or do I hedge it? What do I do with that position? And the firm is at risk during this whole time, assuming he didn't have a ready buyer or a seller on the other side of the trade. What people did is, because as profits started to become less and less, the commissions were less and less, firms couldn't afford to spend a lot of manpower in handling and processing these orders. So what we did was we used technology to be able to handle the orders without individuals. So we built, as well as we automated the industry from the delivery side, we now had to automate it as how do we turn that order around? How do we make a profit on that order? And while, you know, it was great relying upon a very smart young person, and it was only young people, because the average burnout time from a trader on Wall Street, you know, up until about 10 years ago, was literally 6 years. Nobody lasted on a trading desk for more than 6 years, because the stress was so great. So what we did was totally automate the process, all right, and provided a tremendous amount of information through technology to help the traders make decisions, by giving them all sorts of news screens, all sorts of economic data or currency. If you go to a trading firm today, they sit in front of 20 different information screens each. How do they understand it all?
Take all that in, yeah. I mean, I see that whenever I go.
You saw that if you went to our firm. They're young, and they obviously don't digest all of it properly, which is why we hired people like Josh to say, okay, look, let's take the human factor out of the equation, you know. And some people look, when we started our firm, not with me, because I was happy enough to graduate college, you know, but then we went through a period of time where we didn't hire anybody that didn't have an MBA, because we felt that, you know, MBAs were the right people to have working for us.
Thank you.
You know, then we went through another stage where we said, actually it was my wife, you know, who said, why don't you hire, you know, math people? Why don't you go to MIT and hire math people? Because if everything you're doing is related to algorithmic trading and those sorts of things, they're probably the best people. And that was true, but we didn't have much success with the people from MIT. They spend this has nothing to do with the institution, I believe. They spend too much time thinking. You know. I understand that's not something you people want to hear, but that's what happened. You could actually watch them. They would be delivered an order. They now are long 1,100 shares of IBM, and you would see them. And my brother and I and my sons would look at them saying, well, you know, and they would say, I'm getting there. And by that time, the price had moved usually against us. So we determined that the best thing for us to do was basically to take the human being out of the equation. Now, that had two advantages in our industry. Number one, when you take the human being out of the equation, you solve your regulatory problems, because the nature of any human being, certainly anyone on Wall Street, is, the better deal you give the customer, the worse deal it is for you, because you're on the other side of the transaction. It's like going into any store. The store sells you a television at a higher price, they're going to make more money. They sell you the lower price, their profit, goes down accordingly. So as honest as you can find, you try and get people to be. There's this normal, natural pull, that you have to deal with. So by taking the human being out of the equation to a great extent and turning it over to a computer to make the decision, I guess you could also program the computer to violate a regulation, but we haven't gotten there yet. The issue is by taking the human being out of the factor and putting someone like Josh to go back and run all sorts of algorithms, and he can explain that to you, because every time he tries to explain it to anyone in the Madoff family, we walk out of the room after 15 minutes. But by doing
Maybe we don't want him to do that.
Right.
Exactly.
By doing that, we were able to automate the process, and where today, just to give you an example, the scope of that, we were able to take an operation that had, he's probably going to ask me for a raise after this, where we had, let's say, 40 people, doing 300,000 transactions a day, which is what our normal transaction count would be. We have a team headed by Josh and 5 people, 6 people?
Yes, 7, I guess, including.
Okay, 7 people, handling that same thing that 50 people, might have been involved in. And this is what all market making firms, do today. That's the way they operate.
Well, so I'm going to ask this of both of you, but I'm going to start with Mickey. So this is great. We've gotten rid of all these irrational, flawed, error-prone, corrupt people, potentially so. And also, just when you hear that old system of having to call up every single dealer, it's clearly much better in a lot of ways now. But have we reached market nirvana? Are prices set perfectly now? Is the market any safer than it used to be?
No, markets are still influenced by stories, by fashion trends. They're the same companies, but why are they selling twice as much 6 months from now, or half as much? The public has changed the way they're putting in their orders. 2/3 of our orders every day are put in by the computer of our retail trades.
Right. Do people trade more frequently than they used to because of that? Or?
Some yes, some no. We still have customers that want to talk to a broker. They pay more. They're very happy doing that. For the most part, they're larger accounts. But we don't cater to them, but there are the day traders today. And they're aggressive. And some of them blow themselves out of the water very fast and furious. And there are firms that cater to them. We have, for the most part, they're larger accounts. They're self-made people, and they know the markets. What you lose on the commissions, because you don't make much money on the commissions anymore. They're a fraction of what they were. You're making in some of the others. You're making some of it on the money markets.
Because there's some discount brokers that even offer 0 commission trades in certain cases.
Yeah, but
right?
they're making it up in fees.
Right.
They're making it up in so many different ways that the public doesn't see. But we're competitive on margins, and we have a pretty good margin rates. But
margin is when you're borrowing money to buy.
When you're borrowing money, but the firm makes money on that. Not a lot per dollar, but it's a good source of income. As are some other products. We make money. I did something right 10 years ago. we took over the largest black-owned firm in municipal bonds. The founder left, hired Johnny Cochran, and we created Siebert Branford Schenck. And we qualify. We were just appointed by California to senior manage a $2 billion deal. So we have done what we qualify either as a minority firm because of Branford and Schenck, or we qualify as a woman-owned firm. And we have, because of myself and Suzanne Schenck. And we've passed, I think we're number 15 nationally now in terms of senior managed deals. So we've found niches in the marketplace.
So, I mean,
But you have to find a niche.
Right, because the basic trading doesn't.
Because the basic trading's changed.
Well, then, so trading's faster, it's cheaper.
But it's electronic. They get the quotes electronically. They can get level 2. They can see who's bidding what. I mean, it's changed.
I guess I just want to ask Bob, faster, cheaper, also better?
No.
Why not?
Yeah.
Well, it's better in certain respects. And when you talk about the linkages, they can pull all the quotes together in one screen. I go back long enough where I was, remember going up to a broker's office and I had a bond and I wanted to sell it. And he called a dealer. I said, call another dealer. He calls another dealer. Try a third dealer. I mean, he's going through the telephone. That's terrible. Now, these linkages are much better. No question. Technology, though, we keep forgetting, technology is neutral. It doesn't care. It can help you, it can hurt you. It depends on how it's used. Now, I would like, if I could, to raise a question.
Please.
And that is, the question that we could all think of is, what is it that a marketplace does? You know, you can look at specific players in the marketplace and what each individual does, but what does the market do? Why do we need markets? Well, of course we need markets because if I want to buy something, I have to find somebody who sells it. But the transfer of ownership is trivial. Okay, it's necessary, you do it. But that's not the big problem. The big problem is finding the price to make the trades at. I come from a business school background, as does Elsa. We both trained in similar ways, and you can take our Corp Fin courses, our investment courses, and the like. It's all about, give me information about a company, how do you value the company? And, you know, give me growth rate, risk, all the discount rates, all that sort of stuff. What price do you put on it? You get the impression that you can value companies in that way. I suggest, Justin, you can't. And the reason why you can't is that we all look at this information about companies, and God knows there's a ton of it. It's huge, it's complex, and it's imprecise. You look at it, and we come to different decisions. So where does price come from? If you do your best, you sharpen up your pencil and you go through and you figure out that stock's worth $32.12. Well, you got a hell of a sharp pencil if you can get it down to the 12 cents. But you come up $32, okay? And I say it's 42, and Josh says it's 40, and you know, we're all over the place. So where should it trade at? What is the price? That's what we need a market for. Now, when you come to the market, and if we're all... Is that a margin call coming up?
Not on Saturday.
Oh, thank God. Well, you don't know, the market never sleeps. Yeah. Now, what was I saying? We all have our ideas, and we come to the market. Think about it. The process of going from our individual assessments to a price that the thing is trading at is an integration process. We have to integrate our orders. How does that happen?
Because it's different from a vote. I mean, one way you get everybody to agree is everybody votes. And clearly a market is a different way
You vote
of getting...
with your dollars, and if you're bigger, you have more votes.
Right.
But still, dollars vote. Each dollar has one impact. Okay? So you come together, and that's where I come in with market structure. Because if you view it as an integration process, how are your orders integrating? You, the buyer, sell. How does it come together to find a price? Well, technology helps, and you can get the orders in. But technology can do two things. It can compute. That's great. We call it a computer. It can also convey. It transmits orders, it transmits information. Now, if everybody else is walking at a certain speed and I can go faster, I'm better off. What's happened now is that the computer has sped it up for everybody. And what happens in a minute used to take an hour, or you go back long enough, a day. Now we go into, ooh, I can beat you by a minute. I can beat you by a second. I can beat you by a millisecond. It's so damn fast. But our standard market mechanism is called a continuous market. Start trading at 9:30, our standard hours here in the US. You start trading at 9:30 and you trade into 4. Doesn't mean that you continuously have trades. It means the market's continuously open. Anytime a buy meets or crosses a sell, boom, you got a trade. So it's stretched out. Now, when you talk about consolidation of orders, you can think of orders all being consolidated in the same trading venue, like the NYSE or Madoff or whatever. Receiver. But you handle, you're not a market maker.
No.
You handle it. But in any event, the typical view in all the regulatory discussions of consolidation is always spatial, in one place. Time is a terribly important factor. And the orders get stretched out over time. Now what we've done is with this rapid handling is we've compressed time. But at the end of the day, one order is going to come in before the other order. And Josh, if you know you have to do it faster, the guys from MIT are thinking for 5 minutes. Now let the MIT guys think for a second, and they've missed it. So in what way has technology helped us with that? Now, I have an analogy that it's not kind to me, but it still works. I go to a ball field. You see an exciting play. I don't want to bring up the Mets or Yankees. Dismal play, but you know, and boom, the ball's hit. Everybody leaps to their feet because by doing it, you can see better. No, I see worse because I'm shorter. I can see better, but everybody individually thinks that. You can't improve everybody by just the analogy to height is how fast you get in there. Now, the order, the sequence in which things happen it matters, and it's just like a horse race. And you know that you want to know, people bet on the horse, you want to know who crosses the finish line first. So you have so-called photo finishes. When you have a photo finish, you can say, horse A won by a nose. Well, now our cameras are so damn precise, and our timing is so exact, that you can say, horse A won by a milli-nose. Is that good? Well, you have to find a winner with horses. And at some point, but with stock, can't we at some point say, you know, the secret, the milliseconds, there's no information in it. It really didn't matter. We're not using the computer right. If we could integrate these orders better, we'll get better prices. Now, if you ask me how to do it, hey, I have some ideas, but it's complicated.
Yeah, but at the same time, these orders change fast according to the news. News comes out from a company. You look at their earnings, you see the orders changing on the spot.
Oh yeah, you certainly do, but you see them changing without news too, because a lot of the news is in the other orders.
Yeah, but you know, this is not a problem. This is not the fault of the markets. I mean, it's our whole life. I mean, it used to be, you look at fax machines, you look at cell phones. It used to, you know, everybody wants everything immediately. So that's the way the world is. So the same way that investing has dramatically changed. Investing used to be somebody who would, you know, the average person, the little old lady from Pasadena, we used to call them in Wall Street. You always wanted to be on the other side of her trade because she knew nothing. All right, as opposed to the hedge fund manager or the market professional who had access to all sorts of data when he was making his decision to buy or sell. So the investing has gotten so fast because the average person who used to go home and read the newspapers or read a research report or speak to his broker, who, they virtually don't exist anymore, the old type brokers that you would call to speak to, that took time. That was a slow process, which, like, I guess we'd like to go back to lots of different aspects of our life and say, does it have to be so quick? It is, but that's the reality of life.
Because doesn't wisdom come in contemplation to a certain extent? And if the information gets more, if you're constantly absorbing, if you're a trader sitting there with 18 different sources of information coming at you.
Well, there are long-term investors in the marketplace. There are plenty of them, and they're quite successful. So there's long-term investing, and they don't care. They don't care about a lot of this data, getting it instantly, because quite frankly, yes, the value of a company stock changes instantly, based upon anything that happens. It could be currency news, it could be world economies, that are changing. All of that impacts the stock price. Now, does it really matter, which is what I guess Bob is saying, and other people have always asked, does it really make a difference whether if you like, Intel, does it matter whether you pay 46 or whether you pay 47 even? If the company is going to develop, if it's going to be worthwhile, it's not going to matter whether you pay it. And we used to argue with regulators about this all the time, where the industry was held to everybody being within 1 penny of each other on an execution. And we would say, listen, does it really matter? I mean, we used to say by making it so costly to do business, by us taking the spreads away so that the dealer couldn't make the right commission or the right spread to reward him for whatever risk he had to take and the costs in doing the business, by taking that away, then people said, like I said before, I don't want to deal with the public. So we used to say, what difference does it make if a customer pays an extra penny? Because it's not worth a while to do business with them, but you're going to hold us to that standard. So, and in the long term, it's not going to matter. So whether you as an investor pay 46 or whether you pay 47, if the stock's going to go to 50, it's not really going to matter that much. But that's the average small investor that thinks that way, or the long-term investor. But they don't control the market today. The market today is all institutional. And institutions, all they do is measure themselves against other institutions. So to them, a penny is a lot, or a second is a lot. Because if institutions, if they're taking, a second more to execute a trade than another institution, they're measured, somebody's measuring them.
Well, I guess the question then is just, is that a good thing that's what, because there's this long tradition in economics, I mean, definitely going back to Keynes and through James Tobin and Larry Summers, of saying, hey, maybe we should have, although Summers has totally sworn off this after he actually had power in the Treasury Department, but maybe we should have a tax on every transaction so people don't trade so much.
No.
And so why, I want to let Elsa, I mean, why did that never, because obviously there is this law, I mean, people have made these arguments, and there's all these people in Europe who think, lobby for the Tobin tax.
No, I think certainly there's a lot of academic evidence now from colleagues of Bob's at NYU that shows that just adding a little bit to bid-ask spreads to trading costs has a big impact on the value of the stock, an unexpectedly big impact. So that if you start taxing trade or increasing those bid-ask spreads, you will see stock values going down, okay, and that's really important.
Just because it raises the trade in and out really quickly.
So the cheap trading is very much a part of making the cost of capital low for companies trying to raise capital. So no.
Well, and that's the thing we haven't actually. Well, no, you say yours, then I want to come back to my question. What?
Yeah, it's the idea of throwing sand on the tracks to slow the
Right.
train, which is absolutely absurd. It's nuts. The thing is that bigger markets are better markets. Bigger markets are generally more liquid markets. And trading per se doesn't create the volatility. If you come to the market and you place an order on the market, it's called a limit order, and you're helping to build the book, then you're bringing liquidity, and that speeds things up. I mean, it improves it lowers transaction costs. But you can't start putting a transaction cost on and people who go in by market order and not on limit order. I mean, that's absolutely absurd.
Well, Elsa just brought up something that's sort of this crucial part of the whole stock market equation that we haven't really talked about much. Is it's the cost of capital. It's how companies either raise money or figure out what they're worth and help steer their investments, and it's how individuals like us save money and invest money for our retirements and whatever else. And I guess that's sort of, if we could step a little away from the microstructure and get back to that bigger question of, are we any better than that? I mean, do markets do that any better than they used to? Is there anything that ought to change?
Well, let me start off by saying that, of course, there's a huge debate these days about, are we being over-regulated? So Sarbanes-Oxley, and is there too much securities litigations? Those two things are things that people worry about a lot, and that might make the listing on U.S. markets less attractive. So there's been research showing, indeed, that foreign companies tend to be a little less enthusiastic about coming to the U.S. than they used to. The same is true for smaller companies. They're looking for ways to raise capital privately, perhaps not go public. I think this question should be thrown out to the practitioners because it's a very recent development. What do you see?
Well, markets are going global.
Yeah.
And within a few years, you'll be buying foreign stocks with the same ease that we buy the stocks on the board or on NASDAQ. That's happening, and that's happening fast. I happen to think that we need global securities regulations, the way we need global banking regulations, the way we have them. We've seen the worst. There's a lot of debt out there. Some of these private equity companies are being bought 7, 8, 9, 10 times debt. One of the institutions told me they just saw one at 12 times debt. It doesn't give you much room for error. It doesn't give you, the company, much room for error. And I think you have to see it because the hedge funds left the U.S. because they couldn't borrow enough money. So they went to London where there are no margin requirements. Now, if you want to turn the markets into a crap game, but you know, with the hedge
so
funds,
that really
we're
limits what you
dumping.
can do in terms of regulation within just one country.
No, but I think that England bailed out a bank.
Right.
Germany bailed out a bank. You're starting to see things that are talking about regulating certain things because it started to hit them in their ball games. When it hits their banks and their public, then they will start to say, should we have any margin requirements? If we get 3 days like yesterday, you're going to see margin calls. I saw people wiped out in 1987. You know, the 25% equity is a Fed call. And it's not a nice thing when people come in crying. I mean, I saw it when we wouldn't extend more margin to a woman. And she said, well, look what I've made. I'm worth $500,000. She came back begging for us to take the account back when she was worth $20,000 in 6 months. So if you see people starting to lose because of some of this, it might affect, do they play the market, do they invest in the market or not? And I think it's imperative. I think the capital raising system is partially responsible for the success of this country. That there was money, that you had these geniuses, and these firms got 50 people to back this genius. And they've turned into good companies and good people. And
there you guys have it. Bernie Madoff was a huge criminal who built an enterprise based on lies, deceit, and strong projections of good performance. Unfortunately, I strongly believe that he was far from being a unique case, and more of the norm. Regulations on Wall Street are incredibly weak and we need stronger change. Do me a favor and share this video with everyone you come across with any semblance of interest in this type of subject. Thank you all for making it to this point. Let me know your comments down below. I hope to see you all on the next one. Don't forget to join my Discord and to the moon.